Info Edge has its fingers in a lot of pies, be it jobs, property, matrimony, or food and financial services. And their top line shows a healthy growth in the second quarter. What's not so enticing is the bottom line, which came in at a negative 10.92 crores. So what caused this pain? Let's ask the company's MD and CEO Hitesh Oberoi. Hitesh, thanks very much for taking out the time. Let's talk about the quarter gone by. The growth momentum had been maintained, but the bottom line suffered a bit. Can you talk to us a little bit more about what drove earnings in quarter two?
Yeah, we had a reasonably good quarter. Things slowed down towards the end of the quarter, but it was still an okay quarter overall. The recruitment business continued to do well. The IT markets IT companies continue to hire, and that's been sort of, as a result of that, all the IT cities like Bangalore, Chennai, and Hyderabad, our growth rates in these markets continue to be high. The non-IT market slowed down a bit, but overall we still managed to grow our revenue by about 18-19%. The real estate business, also slowed down towards the end of the quarter, but we still managed to grow our top line by over 20% in real estate in a market which has been declining or stagnant for a long time now. Even in the matrimony business, we had slowed down for the last 3 or 4 quarters, but in Q2 of this year, we managed to grow the business by over 15%. The bottom line, the standalone numbers, are not so bad. I mean, what you see is a result of some consolidation and some accounting sort of and write-offs, etc., because of our investments in startups. But standalone, the EBITDA numbers also grew by over 15%, and they would have grown at an even higher rate had we not invested aggressively in the matrimony business, which is where we lost about 17 crores at the EBITDA level last quarter. So overall, not complaining, but yes, we are beginning to see the signs of a slowdown in our business as well.
Okay. While you're talking about slowdown, we are still seeing some hiring that happens in the IT services space. Is it likely to support, Naukri with regards to an outlook from quarter 3 and quarter 4 as well? Do you see that picking up? And the overall property market, which seems to be a bit more sluggish, you've done well in terms of seeing growth in segments like new launches and commercial sales. So you've managed to balance that out as well?
Yeah, so about 45% of our business is IT and IT-enabled services, and these companies have been hiring like there is no slowdown. And the truth is, they are more indexed to what happens in the global economy and the US economy than what happens in India. So if this hiring continues, we should be fine. But if the IT markets also slow down for some reason, then of course we may have a problem going forward. In the non-IT markets, we are sensing a slowdown. Markets like Bombay, for example, grew at only 10% last quarter. So if things slow down further in the non-IT segment, then that could hit our business. The non-IT markets, non-IT part is still 55% of our overall revenue. So let's see how this plays out. I'm still confident that at least the IT markets will continue to be like they are. They may not sort of get better, but hopefully things will not slow down in that space, at least in the next 1 or 2 quarters. But let's see how it plays out. In the real estate business, it's been for the last few years, we've seen several ups and downs, starting with demonetization, then RERA, then GST, and now this NBFC crisis. This NBFC crisis has had an impact on builders and new launches and developers, and so things have slowed down a bit. There is a fund crunch in the space, but of course the government has recently announced sort of a scheme to help out projects which have been stuck for a while. It's a big part of the problem in real estate, especially in markets like Delhi and Mumbai. So if this sort of scheme starts to have a positive impact on the real estate market, things should look up from here. But otherwise, who knows? I mean, it's very hard for me to say whether the real estate market will hold up going forward.
You also continue to extend on your marketing spends, for recruitment and Jeevan Sathi. How much of a market share gain are you expecting on the back of these additional spends?
Yeah, so we bumped up our marketing spends for the last few quarters. Both the recruitment business has benefited immensely from the spend. We were out of media for a long time, And when we went back to media, we saw a huge surge in, for example, our monthly active user base, our resume registrations, the engagement on our app, the number of app downloads, and so on. So I think that's been good for us, and the ROI has been great on this investment. On the matrimony side, we are actually right now in a war with the two other players in the space, Jeevan Shadi and Matrimony. All the players in this space have upped their advertising spend significantly over the last couple of years now. Maybe these companies together were spending 100 crores on marketing 2 years ago. Now we are collectively spending 300 crores a year on marketing. So that's how much the spend has increased in this space. We are fighting for share, and we are sort of getting great results. The matrimony space as a whole is probably growing at 8-10% per annum. We grew at 15% per annum last quarter. This quarter, for the first 6 weeks, we've been growing at over 25-30%. So we are very happy with the progress, and therefore we will continue to spend aggressively in the matrimony business to gain share.
Let's talk about your investments in new startups. Obviously, so far you've seen this policy of incubating new businesses working well for you. While you're making these kind of investments, what is the outlook with regards to how these new ventures that you're investing in will start to actually contribute, and when will you start to see them contribute?
So, we've been investing for over a decade now. Some of our better known investments, people are familiar with Zomato and Policybazaar, but we've invested in over 20 companies in the last, decade or so. And now we are actually, we sort of classify the investments as two types. There are financial investments, which we make purely for financial gains. And these are often in non-related businesses. So a lot of our investments, for example, in the B2B companies we're investing, or in some high-tech companies that we're investing, are non-related to our core businesses, and they're, we are mostly financial investors. Of course, we would like to stay invested for a long time, even in these companies, but our intent is financial. Then there are the other investments. For example, we acquired IIMJobs some time back. That's a purely strategic sort of acquisition. There are a bunch of other companies we are investing in areas like education and real estate, and these are more strategic to us. So they are, they are core to us. So here we would obviously over time want to own a large chunk of these companies if the companies do well. So this strategy will continue. We see a lot of opportunities both on the financial side and on the strategic side, and hopefully some of these investments will work out well in the future and add to our growth rate in the company.
Let's talk also about, we've already seen the cash burn rate for Zomato coming off. Do you see that going down further along with the other new ventures?
Well, Zomato, has been working hard to bring down its burn, and from a peak of, $45 million a month of burn just 6-8 months ago, October was maybe down to about $20 million burn at the EBITDA level. And this sort of, cut in sort of losses has been achieved without sacrificing without sacrificing volume growth. So now they're of course, working hard to ensure that business continues to grow, and but at the same time they don't want to sort of burn too much money. They want to sort of slowly move towards profitability. Now that may not happen overnight, but if the market stays rational, and we don't see our competitors spending a lot of money or behaving irrationally, then of course one could get there in a few months, or one could at least aim to get there in a few months without sacrificing real growth.
My last question with regards to more funding, any requirements at your end? I mean, the way that you're looking at incubating new businesses, marketing spends increasing, are you okay on the funding side, or you will require more funding?
Yeah, so the company is currently sitting on 1,500 crores of cash, and the Naukri business generates an EBITDA of about 450 crores a year. So for our day-to-day sort of business, we don't need any more funds. In fact, we have a surplus, even after investing in companies outside. But where if we may need funds is if we go for a sort of big acquisition. but that is opportunistic. I mean, we've not really acquired a very large company in the last few years, but if there is an opportunity which sort of presents itself in the next few months, and and we decide to go for that opportunity, then of course the company may need to raise more funds, unless of course we do a deal for stock and not cash.
Yeah, okay. Hitesh, I mean, your stock is doing so well that even that would be welcome from a acquirer's perspective. Just one final question on this conversation. As I look at your first half, it's a story of very strong revenue growth and a moderation in burn rate. But by your own admission, things are slowing down a bit. And you would have probably cut down on 99 acres only because that segment by itself is not doing well. Otherwise, your marketing spends are also moving up. Would the story in the second half be different on the burn rate as well as the revenue growth rate?
We take a slightly sort of medium to long-term perspective on these things, and in the past what we've seen is that slowdowns are actually a great time to gain market share. Because, like I said, we are a cash-rich company, we're sitting on tons of cash, the Naukri business is very profitable. Very few companies in the internet space can boast of a business which makes a lot of money and generates cash. And what we've seen is that in a slowdown, people and companies tend to slow down on their investments, they cut costs, they sort of try and, but on the other hand, what we've seen is that in the past, slowdowns have been a great opportunity for us to get shares. So we don't really want to cut down on our investments, whether in product or technology or platform or brand building, because slowdowns, what we've seen so far, are always temporary. And if you can, and are great times to gain share. So if anything, we will actually pump up our investments in the slowdown. We'll try and do more things to gain share in the market.
Well, continue doing the good work. Viewers, just for perspective, the last 5 years, Info Edge as a stock has given returns north of 180%, and a large portion of that has come in post-2017. So you can virtually say that since 2017, in 3 years, it's been about 186% uptick in the stock price. The market certainly likes what you're doing, Hitesh. Keep up the good work. Thanks so much for joining in, and all the best for the second half.
Thank you.
That's Hitesh Oberoi of Info Edge. And Zomato is starting to chip in. Let's see what it does in terms of valuations for Info Edge. What Zomato does is essentially turn the valuations a bit. But that's one stock that has done well. The one story that is doing well is what's happened on Friday. Now, ArcelorMittal can finally take control of Essar Steel's Hazira plant. The world's largest steel maker has been at it for years now, amending its bid, paying off Uttam Galva's lenders, and facing a series of legal cases. And its entry will change the dynamics within the Indian steel sector in arguably more ways than one. Lakshmi Mittal and his team have a reputation of turning sick facilities profitable, has the financial wherewithal to wait it out in the interim as well. So what does it do to the Indian landscape? Let's get in somebody who looks at this very, very closely. Rakesh Arora, Go India Advisors. In a manner of speaking, our go-to person whenever such big announcements come in. Rakesh, good having you. Thanks so much for joining in. Neeraj here, good morning. Your prima facie assessment, Rakesh, of what does this do to the steel space in India?
Well, see, Indian steel space was dominated by only two players, JSW Steel and Tata Steel. And Tata Steel also was little bit, I would say, focused on Europe in the last 6-7 years, and that allowed JSW Steel to grow really fast. However, now, Tata Steel is focusing back on India, and now ArcelorMittal has come back with a big chunk of 10 million ton capacity. So I think it's become much more, a three-pronged race, and which is good for the Indian steel consumers because there will be enough competition and there will be enough supply coming in on board. So I would say good times for steel consumers.
Good time for steel consumers. What does it do to the players? And we'll probably make our viewers hear something that Sajjan Jindal had to say a bit later on. But I remember in an interaction with Menka at Davos, Sajjan was pretty upfront about how it will benefit the incumbents, Rakesh, if indeed ArcelorMittal doesn't make an entry. Now he has made an entry. What happens to that space then?
So what happens is that, see, you have a very strong, financially very strong player, and who is focused to grow. So he's not going to really stop at 10 million ton capacity that he has acquired. Already, they've made, hints that they'll increase this 10 million to 15 million ton. And also over the weekend there are news about putting a plant in East India where a lot of iron ore mine auctions are happening. So I think you will have a very aggressive player who would be determined to increase his presence and market share, and to that extent it doesn't really augur too well for the incumbents JSW and Tata Steel, because they will face increasing competition. Secondly, the big chunk of profitability used to come from auto steel, which is where I think ArcelorMittal with its joint venture with Nippon can really hurt the incumbents. So both aggression and in high-end products is where the incumbents will face a lot of competition, and to that extent, that's why I said steel consumers would be very happy with this.
Rakesh, we're just looking at the Hazira plant and the location thereof vis-a-vis what the incumbents have. So in terms of areas that they can, and I know companies can transport commodities in a meaningful way, but I'm just looking at purely the production facilities. ArcelorMittal doesn't have too much of competition in the area that it is, at least the plant is located. My question to you is, some point of time JSW Steel had mentioned to us, Sheshagiri Rao I think had mentioned that ArcelorMittal can't do a geo to an Indian steel industry. I don't think we're talking about statistics that stark, but at a point of time when everybody was hoping for some recovery in the markets, etc., over a slightly medium-term market, over a slightly medium-term period, does this put a spanner in the works for profitable expansion plans that both JSW and Tata Steel had for themselves?
So first of all, Indian steel industry is very small and is part of a global steel industry. So unlike a telecom provider where things are confined to a geography, steel can actually really travel very far. And the ArcelorMittal assets in Hazira are very well placed because they are port based, so they can ship their product to anywhere in the country at a very economical freight cost. Number two is that they are very near to the auto hub. So basically India's auto hubs are Pune or Aurangabad or Chennai or Gujarat, and Hazira is very well placed to service those kind of auto hubs. And finally, having said that, all the three companies have their, I would say, they will be forced to actually expand because all the three have actually bid for assets at a reasonably high valuation. And to make them profitable, they have to increase capacity through brownfield expansion or debottlenecking. So when ArcelorMittal is talking about taking SR steel capacity from 10 to 15, the logic behind is to reduce the capital cost. Same is the case with Tata Steel's Bhushan acquisition or JSW's acquisition of Monnet Ispat. They all have to really improve and increase the productivity of the asset that they've recently bought. So I don't think they can shy away from investments, which means that there would be an oversupply situation in India for some time. But fortunately, India doesn't really decide the steel pricing. It is decided by China, which is the major player with 50% market share. So India is a price taker, but the domestic premium is going to be lower when there's an oversupply here.
That was going to be my next question with regards to the supply and demand dynamics. Now with the fact that you're saying that the other players also will have to start looking at expanding capacity, that could mean, do you see that going up to levels where you actually see a glut? Or the fact that this could be something that comes on stream a few years down the line and things could start improving materially from there on? Because right now the industrial steel segment is suffering. There's not much demand that's taking place either from the automotive space or, for that matter, construction and infrastructure where the demand comes in from. So that's a bit sluggish at this point.
Yeah, so demand has been pretty weak, and so if you look at current steel pricing in India, it actually last month went down below the the import duty pricing, where the import duties kick in. So actually the prices was lower than what we thought it could actually go. So there's already a a demand shock which India is going through, And looking at the GDP forecast for the second half, when everybody's talking about a sub 5% GDP print in Q3, the recovery is going to be slightly muted, and it can take longer for demand to really come back. So domestically, I don't think there's too much of green shoots for demand to pick up in the near term. All eyes are on China actually, because China can swing the market quite dramatically, and I think globally next few months look still okay, because one, China is going into that winter season cuts, so their production would be lower. Number two is that we're expecting the trade war to see at least conclusion of phase one, which could be sentimentally positive. And number three is that there would be some restocking demand from China pre Chinese New Year. So all these things factor. Maybe there would be a little bit uptick in the international market, which will support domestic steel companies. But beyond that, we'll have to look for Indian demand recovering to really absorb this increased supply which will come through.
I'm not giving you a time frame, because I leave it to your discretion as to what would be the apt time frame once ArcelorMittal comes into action. With regards to the listed metal companies, listed steel space, which company do you feel is most capable of going head on with ArcelorMittal, or probably sharing that space with ArcelorMittal?
Well, see, as I said, it's a three-pronged race. It's between Tata Steel, JSW, and ArcelorMittal now, and everybody is operating in the same space. So the impact is going to be equally out there. It's not that one company gets more impacted than others.
Rakesh, final question then. I remember a conversation that we had maybe 4 or 5 or 6 months ago. Don't quite remember the exact timeline, but wherein you had mentioned that the valuations of some of the steel companies price in some of the tough times. Now, from there, the stocks have moved up marginally, nothing too dramatic. But this changes the equation a bit. Would you still believe that there is merit in trying and owning some of the steel names in India, or would you wait and watch now?
So I think the commodity stocks have actually come off between 10 to 20% since we last spoke. So from say Tata Steel is trading up from 0.6 price to book to 0.65. So not much change. So assuming that global demand remains where it is, maybe the stocks may not have too much of downside. But will they recover in a hurry is the question that we are discussing. And I think next 2-3 months are favorably poised, because as I said, hopefully the trade war phase one settlement should happen. And number two, there would be some restocking demand from China pre-Chinese New Year, which is on 24th January onwards. So these two things give me a sense that probably the rally that we have seen, the slow rally, might continue for another 1 or 2 months. And ArcelorMittal is a long-term impact. It doesn't impact anything in near term.
Yeah. Okay, not in the near term, but maybe in the long term, so can't take a call on that front. Great. Rakesh, so good for you to join in and give us some clarity on what you think this entry means for the steel space over the long term. Really appreciate your time.
Thank you.
Well, the markets have flattened out completely. The Sensex and the Nifty hardly moving, and the Bank Nifty to just about 38 odd points. So no big shakes. We aren't quite zooming up, but in the green, which should be of some solace.
11,900, probably more psychological in nature, just 7 points higher though. But I think that's all we have here on Indian Open. From Neeraj, myself, and the entire team that's put the show together, thanks a lot for watching. But more market action continues on the F&O show on the other side.
So people, when they invest and the calls go right,